What if I told you that the biggest threat to your financial future isn't inflation, it isn't a recession, and it isn't even a stock market crash? It's debt. Not because debt is always bad, but because most people don't realize how quietly it takes control of their lives. Every month, millions of Americans wake up, go to work, earn a paycheck, and then watch that paycheck disappear almost instantly. The mortgage gets paid, the car payment comes out, credit card bills arrive, student loans are due, insurance, utilities, subscriptions. Before they know it, another month is gone, and they're left wondering the same question. Where did all my money go? Here's the scary part. Many of these people aren't struggling because they earn too little. They're struggling because too much of their income already belongs to someone else. Imagine meeting two neighbors. One earns $75,000 a year, the other earns $140,000. Most people would assume the second person is financially better off. But what if I told you the first neighbor sleeps peacefully every night, while the second secretly worries about money? The first owns a reliable used car, has no credit card debt, lives in a modest home, invests consistently every month. The second drives a luxury SUV, bought a house at the very top of their budget, carries multiple credit card balances, financed furniture, pays for everything in monthly installments. On paper, the second neighbor looks wealthier. In reality, the first neighbor is building wealth, because income creates lifestyle, but cash flow creates freedom. And that's the difference almost nobody talks about. We've been taught to measure success by what people own, not by what they owe. A bigger house, a nicer car, the newest phone, luxury vacations, designer furniture. From the outside, it looks like success. But inside those homes, many families are fighting a battle nobody else can see. The pressure of making next month's payment. Here's why this happens. Banks don't sell money, they sell convenience. Think about almost every financial advertisement you've ever seen. Only $399 per month. Zero down. Low monthly payments. Notice something? Nobody starts by telling you the total cost, because monthly payments feel small. They're designed to. Imagine walking into a dealership. Instead of showing you a $48,000 price tag, the salesperson smiles and says, "For less than the price of your daily coffee, you can drive this home today." Suddenly, the decision doesn't feel like $48,000 anymore. It feels like a small monthly commitment. And that's exactly how the human brain works. We're naturally wired to focus on today's comfort instead of tomorrow's cost. Behavioral economists even have a name for this: present bias. We value immediate rewards more than future consequences. It's why eating cake today feels better than dieting. It's why buying something today feels easier than saving for it. And it's exactly why debt is so powerful, because debt lets you enjoy the reward immediately, while pushing the pain into the future. At first, that future feels far away. A few $100s here, another payment there. It doesn't seem like a big deal. Until one day, you realize almost every paycheck already has a destination before it even reaches your bank account. That's when people begin saying things like, "I just need a raise. If I earned another $20,000, everything would be fine." But would it? Research has shown something fascinating. When income increases, lifestyle usually increases with it. A better apartment, a newer car, more vacations, more subscriptions, bigger monthly payments. Instead of creating freedom, higher income often creates bigger obligations. This is called lifestyle inflation. And it's one of the biggest reasons high-income earners still live paycheck to paycheck. The problem isn't earning more. The problem is spending tomorrow's income before tomorrow arrives. Now here's something that completely changed the way I think about borrowing. Debt isn't really about money, it's about time. Every payment represents hours of your life. Imagine you earn about $40 an hour after taxes. A $400 monthly payment doesn't just cost $400, it costs 10 hours of your life, every single month. A $1,500 mortgage payment? That's nearly 40 hours. An entire work week. Not buying food, not investing, not building wealth. Just paying for a decision you made years ago. When you start measuring debt in hours instead of dollars, everything changes. That expensive car suddenly doesn't look quite as attractive. The latest phone upgrade becomes easier to ignore. Impulse purchases lose their appeal, because now you can actually see what they're costing you. Not money, life. And nowhere is this hidden cost more dangerous than one place almost every American dreams about: buying a home. Owning a home can absolutely be one of the smartest financial decisions you'll ever make. But the way most people finance that dream can quietly cost them hundreds of thousands of dollars they never expected to pay. The surprising part? Most homeowners never realize what's happening until years later. And by then, the bank has already won. The moment most people buy a home, they stop thinking like buyers and start thinking like borrowers. The monthly payment becomes the only number that matters. But here's the number that deserves your attention. The total interest you'll pay over the life of the loan. Imagine borrowing $400,000. At first, every payment feels productive. You're making progress. You're building equity. At least that's what it feels like. But if you looked closely at your early mortgage statements, you'd notice something surprising. A large portion of every payment isn't reducing your loan. It's paying interest. That's how an amortized loan works. In the beginning, interest takes the biggest slice. Only later does more of your payment begin reducing the principal. This isn't a trick. It's simply the structure of the loan. The problem is that most people never understand the structure before signing the paperwork. And that's why one of the smartest financial moves you can make is surprisingly simple. Whenever possible, pay extra toward the principal early. Even one additional payment each year can shorten the life of a mortgage and reduce thousands of dollars in future interest. Small actions today create massive savings tomorrow. But mortgages aren't usually what trap people first. Credit cards are. Unlike a mortgage, a credit card gives you something even more dangerous. Convenience. You don't feel the money leaving your account. You simply tap, swipe, or click. That tiny delay between spending and paying changes the way our brains make decisions. Suddenly, a dinner becomes easier to justify. A weekend getaway feels affordable. A shopping cart worth hundreds of dollars somehow doesn't seem that expensive until the statement arrives. Then comes the most expensive button in personal finance. Minimum payment due. It sounds responsible. It feels manageable. But minimum payments are designed to keep balances alive for as long as possible. The longer the balance survives, the more interest a lender collects. This is why escaping debt isn't just about making payments, it's about making progress. So where should you begin? Financial experts often debate two popular strategies. The first is called the debt avalanche. List every debt you have. Continue making the minimum payment on all of them, then send every extra dollar toward the debt with the highest interest rate. Mathematically, this strategy usually saves the most money. The second strategy is the debt snowball. Instead of focusing on interest rates, you focus on momentum. You eliminate the smallest balance first, then roll that payment into the next debt, and then the next, like a snowball rolling downhill. Your progress grows larger over time. So which strategy is better? The answer depends less on math and more on human behavior. If seeing quick wins keeps you motivated, the snowball method can be incredibly powerful. If you're disciplined and focused on minimizing interest, the avalanche method may save you more money. The best strategy isn't the one that's perfect on paper, it's the one you'll actually follow consistently. Now let's build a simple plan. Step 1. Know every dollar you owe. Most people know they have debt. Very few know the exact numbers. Write down every balance, every interest rate, every minimum payment. Clarity removes anxiety. Step 2. Stop creating new debt while paying off old debt. Trying to pay off debt while continuing to borrow is like trying to empty a boat that's still leaking. Step 3. Build a small emergency fund. Even $1,000 can prevent an unexpected expense from sending you back to your credit card. Step 4. Whenever your income increases, avoid immediately increasing your lifestyle. A raise should improve your future, not your monthly payments. Instead, direct most of that extra income toward eliminating debt faster. And finally, use unexpected money wisely. A tax refund, a work bonus, a cash gift, a side hustle payment. Instead of asking, "What can I buy?" ask, "What debt can I eliminate?" That single habit can accelerate your financial freedom by years, because every debt you eliminate creates something far more valuable than extra cash. It creates options. Options to invest, options to change careers, options to travel, options to spend more time with your family. Freedom isn't measured by the size of your paycheck. It's measured by how much of that paycheck you actually get to keep. And here's the good news. You don't have to become debt-free overnight. You don't need a six-figure raise. You don't need to win the lottery. You simply need a plan and the discipline to repeat it month after month. Progress in personal finance rarely happens through one dramatic decision. It happens through hundreds of ordinary ones. One extra payment, one skipped impulse purchase, one debt eliminated, then another, until one day you open your banking app, look at your balances, and realize something incredible. You no longer work to make payments. Your money finally works for you. That's the real goal. Not buying a bigger house, not driving a more expensive car, not impressing strangers. Real wealth is waking up every morning knowing your financial decisions belong to you, not your lenders. Because at the end of the day, Debt isn't just about dollars, it's about freedom. And every dollar of debt you remove is one step closer to owning your future. If you found this lesson valuable, don't just remember it, use it. Pick one debt today, make one extra payment, start one new habit. Because a year from now, you'll either wish you had started today, or you'll be grateful that you did.